Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about US stocks entering a bear market. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So we have the Nasdaq that is knocking on the door of bear market territory. We are about 20% off the highs. The S&P, on the other hand, if I'm not mistaken, is still not quite there yet. It's 16%. Overall, it's not been a pretty picture for US stocks. And this comes back to something I mentioned in one of the videos leading up to the Trump tariff announcements. There was this idea that, one of the biggest problems was uncertainty. Now, I'm not discounting the idea entirely, but again, the main problem in the market was uncertainty, that we didn't know what we were dealing with. And given the fact that we didn't know, we're going to have tariffs, low tariffs, somewhere in between, or something worse, potentially, that was kind of creating a bad environment for risk assets in general. And that once the announcement came, we could go on our merry way. Now, again, in one of my previous videos, I pushed back against that idea and not discounting it. Again, I do have sympathy for the idea that there is uncertainty. That definitely is a factor. But one thing I talked about is beware certainty. Beware the fact that, yes, there is uncertainty, but if you have a certain outcome, now one of the possible outcomes that I outlined here becomes a certainty, that certainty could be worse than the actual uncertainty, which I think is exactly where we are now. So really, I entitled that video precisely "Beware Certainty," because again, yes, you have uncertainty in the market, but if the outcome is terrible, you don't have uncertainty anymore, but by what price? So it's really like going to the doctor, not knowing what you have, and and the diagnosis is we have to cut a limb off. I mean, you know what you're dealing with, but it's not nothing too hot. As far as what to expect, I would not make any dramatic decisions at this point. I would try to keep a cool head. And if I had to choose something to watch and keep an eye on, I think the game from now on is going to be played in credit spreads. I think that credit spreads will tell us whether this is something, this is it, as Jeremy Irons would say in Margin Call, or if it's something a little less worrisome. So far, credit spreads have started to widen. Now, this comes with a lag, and the next update we'll get it on Monday, if I'm not mistaken. I don't have access to the live to the live chart, but in any case, this is the best kind of way to keep track of credit spreads. And again, if you're not savvy in that sense, what are credit spreads? What you're basically measuring is, as it says right here, you're measuring a double B rated bond, corporate bond, and you're measuring that against a treasury bond at the same maturity. So a double B 10-year corporate bond against its treasury counterpart. And whenever the spread between the two is low, say like we saw it in February and the beginning of November, that is an indication that perceived bankruptcy risk is low. And why would that be? Because basically, imagine you were an investor and you had to choose to loan your money to the government or a double B rated company. You are taking on extra risk in giving it to the private company because you have to face the possibility of bankruptcy, the possibility that you might not see your money again. So what you do is you give the money to the corporate, and buy that corporate bond. But to do that, you demand a yield on top of what is being offered at the on the treasury curve. All right. So say like the 10-year. All right. And what you're saying is, if, again, going back to what I was saying, if credit spreads are low, if the spread is low, meaning like we saw right here, around the 2.5 range, that is the market's way of telling you that perceived bankruptcy risk is low. If, on the other hand, you start to see credit spreads widen, like we saw in COVID, or perhaps going back to 2001 or 2008, that is generally associated with times of stress, meaning that bankruptcy risk, perceived bankruptcy risk, is higher. And so investors are going to have to demand extra yield, even more yield. And so if you actually were to see these the credit spreads widen even further, that would be a red flag, and it would be really the best way to keep track of things, and without trying to eliminate as much noise as possible. Now, before I finish the video, I'll talk about small caps while we're at it as well, because in my previous videos I talked about the mechanic where really this kind of divergence you had between small caps, what small caps were telling you, and what credit spreads were telling you. All right, because here's the thing. They still haven't updated on TradingView. This is about 4%, so we're about right here on the spread. The problem with small caps is that, again, there was a divergence between what credit spreads were telling you and what small cap stocks were telling you. Because if credit spreads were right in being this tight, then small cap stocks really should have been performing much, much better. All right? Because again, if bankruptcy risk is perceived to be low, then why wouldn't small cap stocks perform well? In reality, though, ever since the 2021 high, small cap stocks have been flat at best. And if you consider, let's not even think about this last week. Looking at last week, we were down 20%. All right. So either credit spreads were right in being this tight, and therefore we really should have expected small cap stocks to outperform significantly, or small caps were right in underperforming, and so therefore credit spreads would have to widen. That was really what really needed to be solved, and what is possibly being solved as we speak. Because right now, small caps are really getting hit hard, and at the same time, credit spreads are beginning to widen at a substantial pace. Right now, if I'm not mistaken, the last read is 4.01, which again basically puts us right here. We are above the high reached in the yen carry trade unwind, and we are nearly at the highs of 2023. I think this is where what will really decide whether this spills into something more, or it is contained to short-term panic. I think if you really wanted to pay attention to something and try to eliminate as much noise as possible, credit spreads are the way. Are really the way to do that, and try to make sense of everything that is happening. Of course, things can get exacerbated by whatever Trump decides to tweet on or post on Truth Social. And again, it is a process. It is an ongoing event, really. We're living in it live, and all we can do is sit and watch, really, while markets take a beating overall, and bonds have their moment to shine. So really, stocks are having quite a rough day, small caps in particular, although the Nasdaq has officially breached bear market territory, if I'm not mistaken. Again, we are down currently 20% on the dime. So that is basically it. The S&P still has a way to go, but again, we'll see if we actually breach bear market territory on the S&P 500. Again, credit spreads are the thing to look at, in my opinion, right now. But at the end of the day, things can easily get exacerbated or resolved by potential progress on both on the upside and the downside, really. On good surprises or bad surprises could move either way, could move the markets either way. And again, it comes back to the idea that yes, we have certainty now, but it's possibly worse than the uncertainty that we had going into the tariff announcement. So again, I would be cautious, as I was pointing out before the tariff announcement. I would continue to be cautious, and I would try not to make any huge bets at this point, given the fact that we continue to see retail pile into stocks. JP Morgan just released data a little while ago. I would categorize that as a yellow flag. We continue to see, again, the markets continue to get pummeled in front of wanting to call the bottom on things, and this could very well be the bottom. But again, I wouldn't be making those kind of huge bets, given the fact that we are being held hostage, as I said many times in my previous videos, by things that are well out of our control. We are being held hostage by economic data and economic policy. And as long as these things continue to have an effect and continue to be in the market, be it with tariffs, just as we saw in these few days, and some kind of fiscal tightening, you can expect more of the same. That's what I'm trying to say. So be nimble, be flexible, and keep an eye on credit spreads, because I think that will give you insight on the state of affairs. I'll leave it at that. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.